What is the history of changing bank reserve requirements? Have you ever wondered how banks manage the money they hold and lend? One key factor in this process is bank reserve requirements. These requirements dictate the minimum amount of funds that banks must keep in reserve against their deposit liabilities. This can be cash in their vaults or deposits with the central bank. The history of these requirements shows how central banks have adapted to maintain monetary stability and manage credit conditions. The idea of reserve requirements goes back to the early days of banking, when banks only kept a fraction of deposits as reserves. They lent out the rest. However, formal regulations began to take shape as banking systems grew more complex. In the United States, the establishment of the Federal Reserve System in 1913 marked a significant change. The Federal Reserve Act required member banks to hold reserves either as cash or deposits at their local Federal Reserve Bank. This was aimed at providing liquidity and stability to the banking system. Initially, reserve requirements varied based on the type of bank and its location. This reflected different risk profiles and banking practices. In the 1920s and 30s, the Federal Reserve started using reserve requirements more actively as a monetary policy tool. After the Banking Act of 1935, the Federal Reserve gained the authority to increase reserve requirements to control excess reserves and curb inflation. For instance, in 1936 and 1937, the Federal Reserve raised reserve requirements multiple times to counter inflation risks from an influx of gold that increased banks' excess reserves. As the 20th century progressed, reserve requirements were adjusted in response to economic cycles and financial crises. The Great Depression led to stricter regulations worldwide to enhance banking stability. During economic slowdowns, reserve requirements were sometimes lowered to encourage lending and stimulate growth. Conversely, in times of economic overheating, they were raised to cool credit expansion. After the global financial crisis in 2008, central banks revisited reserve requirement policies. Some countries adjusted their requirements to strengthen financial stability and manage systemic risks. Technological advancements and the complexity of financial products also prompted regulators to modernize reserve requirement frameworks. This shift emphasized liquidity management and risk control. International coordination on reserve requirements has increased as well, with organizations like the Bank for International Settlements promoting standardized practices for global financial stability. Changing reserve requirements have served as a key monetary policy tool. By altering the fraction of deposits banks must hold in reserve, central banks can influence lending, credit availability, inflation, and economic growth. This tool works alongside others, such as open market operations and interest rate adjustments, to maintain economic balance. The history of changing bank reserve requirements illustrates their role as both a safeguard for banking stability and a lever for monetary policy. From the early fractional reserve systems to today's sophisticated regulatory frameworks, reserve requirements have evolved to meet the challenges of changing financial systems and economic conditions.